Hi guys, we're back. Ray Cousins here with our market video analytics, our weekly program where I share with you guys my personal trading activities, my market analytics, my trading opportunities, top level stuff, and we cover the crypto market, commodities, indices, and above all, the Forex market, currencies. Now, this program is powered by Light Forex Broker. And today I want to revisit the crude oil. Right? I feel that I owe you a follow-up on. This is going to be the second follow-up actually on a bullish conviction that I established back at the 5th of December. There was actually a video session. If you haven't seen it already, go ahead and check it out. Title was "Preparing for a Bullish Flip Over." Right? That's where we started. Taking the bullish stance, 5th of December. About a month and a half, I had the first follow-up, right? It was on the 22nd of January. Title was Pulling the Trigger on the Crude Oil. That's where I actually took action, the 22nd of January. So we're about a little over a month after that first follow-up. So this is going to be the second follow-up. And I think it's going to be super interesting. Let's go ahead and dive in. All right, we got the crude oil daily chart. Quite an interesting story we have here, no doubt. And I'm pretty excited about this because just a few days ago, price made it all the way to my first official price target at 57.37. And I actually pulled out by 80% of the position. So that was a major profit-taking spot for me. And now I'm beginning to re-enter these 80% that I took out. I'm starting to get them back in. But I'm not doing this in one shot. I'm basically dividing this into increments of 10%. So I just got in the first 10% after taking 80% out. And I did that because I saw that yesterday was a positive day and I was expecting that. I was hoping for that actually. Now, I want to dial it back to the beginning of when we started, when I initiated, the bullish conviction and later on actually pulled the trigger on the bullish position. But let me just refresh your memory because the big picture here is remarkably fascinating. Let me take you to the monthly chart quickly and just refresh your memory when it comes to the actual formation that we see here ever since December 2015, right? You can see it right here, this spike here. This is the moment when price had shifted from a major downside trend into a major upside trend, right? And it actually started to move upside in a very nice fashion. I think we're looking at an Elliott Wave cycle, right? Elliott Wave cycle where we had the first wave, the first impulse wave, followed by the second corrective wave, and then of course the third impulse wave, and we just recently had that really intense fourth wave, corrective fourth wave, and right now I think we're looking at the very beginning of the next and last fifth impulse wave, right? And whenever I look at an Elliott Wave cycle, I always like to make sure one thing, and that is that the fourth wave hits and takes the tip of the first wave, right? This is something that is really important. The deeper, the better, right? But you definitely don't want that you don't want the fourth leg taking the tip of the second wave, right? That's illegal, so to speak. So as long as it goes as deep as possible but still doesn't take the tip of the second wave, I think this is the ideal situation, right? Now let me throw in another very, very interesting technical element here. Not only that all these four waves are in line with my standards, right? My conditions for Elliott Wave cycle, but also take a look at this fourth wave, and exactly where it reached. It reached this key level. Take a look, this black dotted line here, right? Price tag 45 is actually a 61.8. The most important, probably one of the most important Fibonacci correction levels, 61.8. If you measure the whole formation from the very beginning of the first wave until the very tip of the third wave, measure 61.8, it will put you right here. So when I noticed that price was having such an enormous reaction to that key level, right, and I had in mind the fact that it should be the fourth wave, which, by the way, the fourth wave is usually the most intense move in all of the 5 waves, right? And that's mostly because of the nature of a counter move, a correction. Usually a counter move, a technical correction is more intense. It happens stronger, faster, deeper than the other moves. And in this case, with the Elliott Wave cycle, it's usually the fourth wave that is the most intense. So, we had all the signs here. And price made it all the way to the 61.8 and turned around. So that's pretty much the moment where I declared, right, that we're back on the upside. We're about to resume the original upside trend and probably initiate the fifth and last impulse wave. However, I was very cautious. I did declare a bullish conviction, but it did not pull the trigger because I wanted to go as safe as possible. And what I wanted to have was price breaking above a very important key level. Let me show you what I'm talking about. 50.30. Take a look right here. So I was counting on price to break that 50.30, and that was my official trigger. But I was not going to be satisfied with just the daily close. I wanted to have a weekly confirmation, right? A weekly close above that key level. That was good enough for me to go ahead and establish a bullish position. So once I had that, I waited a few more days, right? Because I started to notice that price was starting to form this head and shoulders pattern, which was just perfect for me because I was already convinced that price is going to reverse. So adding another inverse head and shoulders pattern on top of that, that was spectacular. But I did wait a couple more days because I wanted to give a chance for price to complete the right shoulder. So I got in right here. Let me show you exactly the day. It was right here, the 22nd of January, right? 22nd of January. That's where I pulled the trigger. And at the beginning, price was just trading sideways, right? A few days were on the downside. Later on, we saw a few days on the upside and vice versa. It was just until probably about 10 days ago when price began to lift off. So I was very happy about that. And the first thing I did when I pulled the trigger on, I started small. I always do start small, start with the first portion, right? If price goes the right way, I begin to increase the position. If it continues, I keep increasing the position till I hit my price target. That's the way I do. That's my money management tactics. So at first I kept it small, but then price began to lift off, and I started to increase my position. But the first thing I did when I first pulled the trigger was measuring the head, right? Because I wanted to know, part of my game plan was to find a reliable price targets to aim for, right? Without a price target, you're kind of in the dark. You got to have that strong, solid key level to aim for. So usually what I do when I have a head and shoulders pattern, well, not usually, always. This is one of the most important and basic principles. Whenever you have that head and shoulders pattern, it's very easy to find reliable price targets. All you need to do is take 2 key levels, right? I had a full session on this on our education our education session. One of our education sessions was all about using the projective, right? The projective analysis Fibonacci projection analysis, and I specifically mentioned two key levels that I always use, right? The 1.236 and the 1.618. So what I like to do a lot is to get out with the big, most of my position to get it out when price hits that 1.236, and keep some of my position for the next one, for 1.618. However, when I take out most of my position at the first one, at the 1.236, I wait a little bit, and if price shows seriousness, right? If it's resilient, if it's sustainable within its upside move, and it breaks that 1.236 with a weekly close, then I'll quickly go up and ramp up that position again. Just re-increase the position all the way to the next one, to the 1.618. And that's exactly what I did here. I mean, I let price hit that 1.236. That was about 4 days ago. And when it hit my first price target, I took 80% out, right? I took profit, a lot of profit off the table at that point, left just 20% in. And right now, I see price begin to turn around again. So I was a little bit concerned. I'm always concerned when price hits the first 1.236, because there's always a chance that it will go either into a deep downside correction, which I definitely don't want to have, right? Or a complete turnover, a complete reversal. That also happens from time to time. So I'm always a bit concerned when price hits my first price target, even though it's a good thing, right? But I was worried about my 20%. And what I did was I also adjusted the stop loss level, which was at 52.50 originally, before price hit that 57.37 there, my first price target. And when it started to turn around, mostly I'm talking about 2 days ago, I was really concerned. So what I did, I tightened up that stop loss level all the way to 54 in hope that price will not take it. But even if it will take it, I'll be very content. I'll be very satisfied with this position and what occurred up until now. However, I do believe that price will eventually come back, break that 1.236, and head straight to the next one. Right? Next one is 62.07, and that is my final destination for this particular bullish campaign. I might reanalyze the situation later on and decide to get in, but that's going to be a different analysis. Right now, I'm aiming at 62.07, which, by the way, it's an interesting price target. It's actually a cluster. This is what I call a cluster. It's an interesting cluster. It is the 1.618, right? The second black key level here, 62.07. That's the 1.618. And you can see that below, not too far, by the way, pretty close, you can find another key level, this blue one. Now, let me remind you, for those of you who are not following us for a long time, you probably don't understand where this level is coming from. But about 2 months ago, probably it was about 2 months ago, I think maybe even 3 months ago, we were involved in a wonderful bearish position, right? That started when price was hitting my top key level on this symmetric setup, because we had a lovely trading range here back then. And when price took the previous highs and kind of spiked that top resistance at 75.08 and began to turn around, that's where I established a bearish position, which was hugely successful. Not because it was very profitable, but also because it was very quick, right? So in a couple of weeks, 3 weeks, I've made a fortune here. Now, I didn't take the whole move. I took about half of it to the very edge of the bottom section here on that symmetric setup. But later on, we saw that price was breaking, and I did specifically said that I believe that price will break that setup because it is the fifth leg in this trading range. And usually the fifth leg is the one to reverse the whole formation. And I was ready for that because, we saw coming from the bigger picture, we saw that Elliott Wave cycle, so I was expecting price to begin that fourth corrective wave, right? And when it did break, I wasn't involved at that point, right? I wasn't involved. I had no position in because it's very hard, almost impossible to predict how deep a downside correction will go, right? And in the case of the fourth corrective wave, it's even harder because sometimes it could be so intense. So what I did was I stayed on the sideline and I waited for the first, important indication signal that will tell me that there you go, this fourth downside correction, fourth wave is ending, and it's going to give way to the next, right? The next bullish fifth impulse wave. So obviously when price hit that 61.8 Fibonacci and began to turn around, right? And later on, I saw that head and shoulders pattern and the break above the key level of 50.3, all of those elements were in line, and it was easy to pull the trigger. But what I was trying to say earlier is that I kept that C-matrix setup, right? I kept it. It was relevant, 2-3 months ago, but I decided to keep it because I knew that when price is going to reverse and initiate that the next fifth impulse wave, this setup is going to come to life again, right? These key levels could be important resistance levels along the way. So I kept it in, and when I measured that head and applied that, these projection key levels, especially the 1.618, I noticed that it was suspiciously close to the bottom key level of my C-matrix setup at 61.13, right? So we have here a range. It's more of a range than just a spot, right? Just two key levels very close to one another creates this range of less than a point, right? Less than a point. And also, let me throw in another element. You probably guessed it already. You can see the 200 daily moving average crawling in, right? Closing in pretty rapidly on that very range. So, if I can imagine price beginning to turn around to the upside and starting to push for a second attempt on that 57.37, it's going to be successful, right? And it's going to continue, and it's going to hit that range probably in a matter of, a week or two. So by the time it hits that range, I figured out that the 200 daily moving average is going to be right there, right in between these two key levels, kind of caged in, and it's just going to make that range super, super intense, super important, right? It's going to create this kind of magnetic field that draws price to it, and when price hits it, it will repel it, right? And probably send it into a steep downside correction. It could even reverse the whole formation. I mean, we do expect price to keep pushing forward according to the Elliott Wave cycle and eventually, surpass the previous high, which is the tip of the third impulse wave, right? This is part of the Elliott Wave cycle. But we could have a deep downside correction along the way, and we're definitely trying to avoid that, right? We don't want to have that. So by tightening up the stop loss level to 54, I'm basically prepared to get out completely, right? To pull out altogether. If price is not going to push forward from this point on, it's going to drop, it's going to take my stop loss level, I'm going to close the rest of my position, I'm going to wait on the sideline, because at that point, I think price could go all the way to revisit that 50.3 key level that got broken. It was tested from above, slightly, very slightly, a few days after the break, right here, right? But I don't think it was seriously retested from above, so it could happen, right? So if price is going to continue on the downside, it's just going to mean that I'm going to wait for price to hit that 50.3, and when I see it, if I'll see a strong reaction to that key level and price begin to turn around without closing below, especially the weekly bar, then I'm going to pick it up again and try to catch price all the way to that same range, right? To that same 61.13 and 62.07. Now, I said earlier that my official price target is 62.07, but let me tell you this, I'm going to be very, very cautious when price hits that 61.13. If I'll see a little bit of a struggle there, I'm definitely going to pull it out quickly, because I'm not going to, I'm not going to risk this type of profit when it hits that range, even though it's just the first key level. So yeah, there you go, guys. Right? We're following up on the oil for probably about 2 or 3 months now, and we are right on top of every single move that's going on here. Let's just hope we can grab this last stretch to towards 62. But even if we're not, I'm definitely going to come back here and follow up on the developments, because the crude oil is so interesting, right? So yeah. In the meantime, guys, I think I'm going to say goodbye for today. I hope you enjoyed this session. I hope it's going to be helpful. And that's about that. Till next time, be well.